Hello, hi students. Today we'll go through one example on how consolidated financial statement should be prepared as per IND AS 110. So let's go through this one particular example which was given in the November 2023 CA final exam. So please go through this question. So here they've given the balance sheet of Hammer Limited and Sleek Limited, and they have given some notes to accounts, and there are some additional informations, so please go through. Okay, so now we'll have to prepare the consolidated financial statement of both Hamburg Limited and Subsidiary Limited together as of 31st March 2023 under IND AS 110. Okay, so now let's get into the sum. So as usual, let's prepare a kind of summary of the question so that we will remember all the adjustments that needs to be done. So in this case, they have given the balance sheet of Hammer Limited and Sleek Limited as of 31st March 2023. That's the closing balance sheet. Individually they have given, and I'll call Hammer Limited as H Limited and Sleek Limited as S Limited, just for the easy pronunciation. Okay, so H Limited has invested 20,000 shares at the rate of 2,40,000 rupees, and this was purchased as of 1st April 2022. Okay, so this was the initial investment, and there was a further investment of 17,500 shares that was purchased on 1st October 2022 at a cost of 192,500. Right, so this is the total investment made by H Limited over S Limited. Okay, so the total number of shares of S Limited is given as 50,000 shares. So out of 50,000 shares, initially S Limited was holding 40%, that is the 20,000 shares, and then they have purchased another 35% shares, that's the remaining 17,500 shares. So together H Limited having investment of S Limited for 75%. So that's important, and let's understand that. Then third thing is H Limited investment in S Limited in the form of debentures. So apart from equity, they also have invested in debentures, 8% debentures of S Limited, and that had a nominal value of 35k, but H Limited has acquired this debentures at 84,000 on 1st Jan 2022. Okay, so this is the third information. And next one, on 1st April 2022, the retained earnings of S Limited was 75,000 and general reserve was 50,000. So these informations is required to calculate the pre-acquisition share of retained earnings and general reserve to the holding company. So we'll see how this should be computed. And the next one, S Limited has also paid dividend at the rate of 10% out of the retained earnings as of 1st April 2022. Okay, so what are the share of dividend relating to H Limited has been given credit in the P&L of H Limited. Okay. Then sixth one, S Limited also declared bonus shares as of 28 February 2023 on 10:1 basis out of the general reserve. Okay, and accounting effect not yet given, so we'll have to give the accounting effect for this bonus issue. Okay, then seventh information, the trade receivable of H Limited includes bills receivable of rupees 2 lakhs drawn on S Limited. Okay, so we'll have to do a bit of elimination. So out of this 2 lakh, 50,000 has been discounted. So generally the trade receivables of intercompany, I mean between holding company and subsidiary company, needs to be eliminated in the consolidation. But in case if something has been discounted, then to that extent we should not eliminate, because once it is discounted, the related party transaction gets knocked off. So this 50,000 actually becomes external liability, not the internal liability. So we should not eliminate this 50,000. So out of 2 lakh, we'll have to eliminate only 150,000. So let's go through in detail later. Then eighth information, inventory of H Limited includes 40% of purchases made during the year from H Limited. So the cost of those inventory was 25,000, and the sale price was at 30,000. Okay, so we'll have to eliminate the intercompany profit on the inventory. So let's see how this should be done. Then the ninth information is S Limited machinery was overvalued by 20k on 1st October 2022, and depreciation at the rate of 10% per annum, and entry for adjustments to be made. Okay, we'll see. Then the last information is H Limited follows IND AS 103. As such, the NCA to be valued at fair value. Okay, assume fair value of H Limited is at the rate of 11 per share when H Limited acquired control over S Limited. Okay, so these are the informations. Let's see how the consolidated financial statement should be prepared. So let's get into the answer. So to prepare the consolidated financial statement, I suggest we follow usually a 6 steps approach. So these are the 6 steps. We can even call this as a standard steps, because almost all the similar sums we can answer, or we can do the consolidation by following these 6 steps. The first step is determine the acquisition date. Okay, so let's see how in this example the acquisition date should be determined. And the second one is we'll have to compute the net worth of the S Limited. S Limited means a subsidiary limited as on the acquisition date. So that's the second step. And then third one is computation of goodwill or capital reserve. Then the fourth one is analyze the reserves of S Limited. So we don't have to analyze the reserves of the holding company, but we have to analyze the reserves of the subsidiary company, so that we'll have to allocate the reserves between pre and post acquisition and between holding company and NCA. So for this we'll have to analyze the reserves of the subsidiary company. And the fifth one is we'll have to compute the non-controlling interest. Okay, then the last step is we'll have to make a consolidation of other equity and the balance sheet line items. So once these 6 steps are done, then we can prepare the consolidated financial statement. Done. Okay, so first in this example we'll go through step 1. So step 1 being computation of acquisition date. So in this case, H Limited has invested on S Limited. As of 1st April 2022, they had 20,000 shares out of 50,000 shares, which is only 40%. So as per IND AS 110, if the holding company holds more than 50% of share, then only consolidation requirement is there. So if they hold less than 50%, then there is no need for consolidation. But we have to follow IND AS 28, where the consolidation or the parent company needs to restate the investment on equity method. Okay, so probably H Limited would have followed the equity method of revaluation of investment up to 31st March 2022. Okay, but consolidation was not required as of 31st March 2022. Then H Limited also invested on 1st October 2022 further shares of 17,500 in S Limited. So that accounts for another 35% investment. So which means as of October 2022, they are having 37,500 shares out of 50,000, which quantifies to 75%. Right, so 75%, since it exceeds 50%, so we can conclude H Limited have control over S Limited. So if they have control over S Limited, then consolidated financial statement is must for the financial year April 22 to March 2023, and acquisition date should be 1st October 2022, by when the further 35% have been acquired. That adds up to total of 75%. So being the date on which H Limited took over the control of S Limited. So acquisition date is 1st October 2022 in this example. Okay, so that's the first step. Then let's get into second step. So second step is computation of net worth of subsidiary limited as on the date of acquisition. So once the acquisition date is determined, we'll have to calculate the net worth of the subsidiary company so that we can identify whether any goodwill or capital reserve emanates out of this net worth. Okay, so how this should be done? So maybe we'll have to draw a kind of balance sheet as on the date of acquisition. That is the 1st October 2022. So I will, let's not compute complete balance sheet. So generally in the balance sheet you'll have the all net assets, and net assets will actually equal to your capital plus other reserves. So to compute the net worth, in short, we can just add the capital and all the reserves which is attributable to the equity, right? So capital plus reserve will actually add up to net assets. Okay, so in this case, capital as of 1st October 2022, that is the after acquisition, the capital stood at 5 lakh rupees. Okay, so then we'll have to see what is the retained earning as of 1st October 2022. So the retained earnings as of 1st October 2022 would be 117,500. So how these 117,500 have been arrived at? So you have the opening retained earnings, that is given as 75,000, and from opening retained earnings it is given that a dividend has been declared. So dividend value is 50,000, that is on 5 lakh rupees 10%, 50,000, right? So from 75,000 you have to reduce 50,000, so remaining opening retained earnings is only 25,000. And it has also been given that as of 1st October 2022 the machinery have been overvalued by 20,000. So we'll have to eliminate the overvaluation that's already included in the reserve, that needs to be eliminated, 20,000. Okay, so then we'll have to add the profit made from 1st April 22 to 30th September 2022. But here what is the exact profit for the first 6 months and second 6 months they have not given. So we can take the total profit. So total profit in this case is 2,25,000 for the entire financial year. So this divided by 2 will give the profit made for the first 6 months. So if you compute all those things, it will add up to 117,500. Okay, one small correction. So this is not 12, this is 2. Okay, yeah. So that's how this 117,500 has been derived. Okay, so then next step is we'll have to compute the general reserve as on 1st October 2022. So general reserve as on 1st October 2022 also. So you have the opening balance 50,000, and there is a current year transfer made for 6 months. So current year transfer made in this example is 75,000, and divided by 2 will give what is the transfer amount from 1st April to 30th September. And they've given bonus has been issued from the opening general reserve, so that needs to be eliminated. So net you'll get 37,500. Okay, then the bonus issue needs to be either added to capital or it can be added to general reserve. So that's why I wanted to show this as a separate line item. Okay, so altogether the net identifiable asset as of 1st October 2022 is 705,000. Okay, then let's get into the next step, computation of goodwill or capital reserve. Let's see whether we have goodwill or capital reserve. So any one only could be there. So if your procurement value is more than the net assets, then it's a goodwill. And if your procurement value or the purchase consideration is less than the net asset, then you'll have capital reserve. So let's say where are we here? So in this case, the net identifiable assets, as we have computed in the previous step, it comes to 705,000. And we'll have to see what is the fair value of the investment or the purchase consideration. So fair value of purchase consideration, we have this 192,500. This is for the 17,500 shares, and initial 20,000 shares. It needs to be valued at the fair value. So fair value price has been given at the rate of 11. So then it comes to 220,000. So 17,500 shares, value 192,500, that's already at 11 rupees per share. And this 20,000 shares, initially it was at 12 per share, but now it's needs to be reduced to 11 per share being the fair value. So together these two adds up to 412,500. So this is the fair value of the investment held by H Limited. Then we also need to calculate fair value of investment held by non-controllable interest. That is the remaining 12,500 shares at 11. That comes to 137,500. Okay, so together the total fair value is 550,000, but the net asset is 705,000. So since net asset is more than the fair value, we are into situation of capital reserve. So the capital reserve is 155,000. Okay, then let's get into next step. Here we have to analyze the retained earnings of S Limited. Okay, so first we'll analyze the retained earnings, then we will also analyze the general reserve of the subsidiary. Okay, it's quite interesting. So retained earnings as of 31st March 2023 is given as 250,000. Okay, then retained earnings as of 1st April 2022, it's given as 75,000. So from the retained earnings opening, they have, in the sum it is given that 50,000 have been declared as dividend, which means the net profit is 25,000 during the year. Okay, then from 250,000 we have to reduce 25,000, so the net profit during the year comes to 225,000. Okay, then this 225,000 needs to be allocated between pre-acquisition, post-acquisition. So pre-acquisition period is from 1st April to 30th September, and post-acquisition is from 1st October to 31st March 2023. Okay, but they have not given exactly what is the profit made up to 30th September 2022. So we can assume on an average, first 6 months is 50% and second 6 months is remaining 50%. So out of 225,000, first 6 months would be 112,500 and second 6 months is another 112,500. Okay, so pre-acquisition profit is 112,500 and post-acquisition profit is another 112,500. So from the post-acquisition profit, there is a adjustment relating to depreciation that needs to be eliminated, and there is an adjustment relating to inventory. So where the inventory have been purchased by holding company from subsidiary company, so the total purchase value is 35,000 and cost price is 25,000. So there is a profit of 5,000. Out of 5,000, only 40% remains in the inventory. So 40% of 5,000 comes to 2,000. So this needs to be eliminated. So with all this, the post-acquisition retained earnings comes to 111,500. Okay, so post-acquisition retained earnings 111,500 and pre-acquisition is 137,500. So being 112,500 from the profit and opening is 25,000. So together it is 137,500. And from the pre-acquisition, there is a overvaluation of machinery that is included here that we have to eliminate. So net will come to 117,500. Okay, so now we have the pre-acquisition profit of 117,500 and post-acquisition profit of 111,500. So we'll have to allocate both pre-acquisition profit and post-acquisition profit between holding company and the non-controllable interest. So holding company have share of 75% and NCA have share of 25%. So we'll have to just calculate, allocate this pre-acquisition 117,500, 75% share to H and 25% share to NCA. Similarly, post-acquisition 111,500, 75% to H and 25% to NCI. Okay, then there is one more reserve, it's a general reserve. So this also we have to do the similar analysis. So we'll have to calculate how much of general reserve relates to pre and post acquisition, and then we'll have to further allocate to the share of H Limited and the share of NCA Limited, NCA shares. Okay, so general reserve it's given as of closing it's 125,000 and opening is 50,000. So which means net transfer done during the year is 75,000. So the 75,000 we can assume 50% first expense and 50% second expense. So opening would be this 37,500 plus 50 will add to 87,500, and it has been given that the from opening the bonus issue has been given. So bonus issue which is 10:1 basis, which is actually 10% of 5 lakh capital, that comes to 50,000. So the balance general reserve is 37,500 from the opening. Okay, so this 37,500 again 75% to H Limited and 25% to NCA, that comes to 28,125, 9,375. Then the post acquisition is also 37,500. So you have the similar value for post acquisition value as well between Hammer and NCA. Okay, so now let's get into the next step, NCI. So NCI first, what is the fair value of NCI? That 17,500 shares into 11, that comes to 137,500. So that's the NCI opening balance as of 1st October 2023. So from here you have to add their share relating to general reserve and their share relating to retained earnings. So this will give the closing NCA value at 174,750. So that's the NCA computation. Then the next step we'll have to do the consolidated workings, so that this working can be used to prepare the consolidated balance sheet. So it's actually simple. So we'll just take from the balance sheet of Hammer Limited and Sleek Limited and then see what are the adjustments to be done when we do the consolidation, and this final total value will be taken to the consolidated balance sheet. So first on the property, plant and equipment, it has been given 600,000 is the Hammer Limited closing balance and 325,000 is the Sleek Limited closing balance. So we'll have to just add these two, and they have given the machinery have been overvalued by 20,000, so that needs to be eliminated. And on this 20,000 the depreciation is 1,000, so net 19,000 needs to be reduced. So your consolidated PPA closing balance will be 906,000. Then next, intangible assets, it's purely the goodwill. So ideally the goodwill would require some adjustment, but in this case since from Sleek Limited we have only capital reserve and not goodwill, so we can assume the existing goodwill, nothing related to the investment from H Limited to S Limited. Probably this could be out of their other investments. So no adjustments are needed. We'll have to just add the goodwill from H Limited, S Limited, that adds up to 200,000. Then third one, investment. So investment, actually that investment as per H Limited, as per the balance sheet, is 625,000. So from here we have to reduce the fair value of investment with the S Limited. So if you reduce, then you will get the remaining value from H Limited 182,500. So this is something they are external investment and not relating to Sleek Limited. And Sleek Limited also have their own external investment 125,000. And from here the adjustment is, so H Limited also invested debentures in S Limited. So the debenture investment value needs to be removed. Okay, so this will give the closing investment of 233,500. Okay, then for the adjustment inventory you have 125,000 from the respective balance sheet and 160,000, and from here the unrealized profit of H Limited inventory needs to be adjusted. So this will give closing of 283,000. Then trade receivables, you have 325 and 290,000 respectively. So as I told you, the H Limited receivable includes 200,000 relating to Sleek Limited, but that has out of 2,50,000 has been discounted. So if it is discounted, then you should not do the elimination. So only the remaining you have to eliminate. So remaining comes to 150,000. So the total receivables at consolidated level will be 465,000. Then cash and bank, it's just simple addition of the two entity balances. And borrowing, you have 150,000. So borrowing of Sleek Limited includes debentures invested by H Limited, that needs to be eliminated. So you will have the remaining borrowing 65,000. Then bank overdraft, just simple addition. So probably this 50,000 is the one from the trade receivables of Sleek Limited that has been discounted. Okay, that's okay. Then trade payable, it's simple addition, and this 150,000 eliminated from receivable, it also needs to be eliminated from trade payable. So that will give remaining 450,000. So these are the working which we can use to prepare the consolidated balance sheet. Okay, so then we also need to calculate the other reserve as part of the consolidated balance sheet. So generally the other reserve should come only from the Hammer Limited. So Hammer Limited have 200,000 general reserve closing balance and 350,000 retained earnings. So from here, this 20,000 is the excess investment carried in the balance sheet that needs to be reduced, and the excess debenture investment 49,000 that also needs to be removed. And then we need to add the post acquisition profit, both from general reserve and retained earnings. So this will give the closing general reserve of 228 125 and the closing retained earnings of 364 625. So general reserve, retained earnings, and capital reserve also will be part of other equity, so that also needs to be added. So you please refer step 3 for the capital reserve. So all together the other equity of consolidated balance sheet would be 747 750. Done. Okay, so with this all the steps have been completed, and now we'll have to prepare the consolidated balance sheet. So please ensure you follow the schedule 3 format. So the consolidated balance sheet of Amber Limited as of 31st March 23. So you have to ensure you in the assets you show separately the non-current assets and current assets, and in the liability will show separately the equity, non-current liability, and then current liability. Okay, so in the asset property plant and equipment, so this 906,000 exactly comes from our working here, 906,000. So from here you can refer all the workings, so that actually adds up to this consolidated balance sheet. So intangible asset goodwill, that comes to 200,000, and then net investment comes to 233,500, net of inventory comes to 283,000, and trade receivable 465,000, cash 500,000. So the total of asset comes to 25,87,500. And then equity, so here we will show only the Hammer Limited equity. Yes, limited equity should not be added here. And other equity as per our working, it comes to 747 750, and the NCA as per working comes to 174 750, and closing borrowing is 65,000, closing bank overdraft is 150, and trade payable is 450. So all your total liability adds up to 25,87,500. So you have the tallied balance sheet. Okay, I think it is clear, and if you have any comments, please feel free to add some message. Thank you.